All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. One of the worst feelings in the world is, in the world of trading, I should say, is to be caught in a whole bunch of upside positions when panic hits the market. Because what happens is you see massive sells, but massive bounces, and so it toys with traders' emotions. It's okay, well, I'll hold it because it's going to bounce. And you see this big bounce, and then you're like, okay, I'll hold it, it's going to cut, and then poof, another flush comes, and we are in that position in terms of the market right now where fund managers are dealing with panic. And that is not something they've had to deal with much of late. And it is something that when we see panic come in, there's a nature to it and how it tends to play on out. And we'll go and we'll take a look at it. But let's start with the challenge. Challenges in all cash. I mentioned earlier this week, I just, with what's going on, I don't expect many new signals. We just aren't going to get crossovers to trigger the signals. Today, we have Dollar General that has a crossover, a downside 3-7 crossover on it. But coming off a new high, just isn't going to give a signal. If we come and look at the scans for just the pure crossovers, you'll see Dollar General is the only one with a downside 3-7 crossover, while Netflix has an upside 3-7 crossover here on it. And that's new since I looked at it. Let's see, yeah, we talked a lot about Netflix yesterday, and it's a stock I really wish would just go down already and give a nice little cheap buy opportunity. But we could see a signal come into it today. That'll be very interesting. That'll be very interesting to see if that happens. We saw some really good volume on it yesterday, and there's still a long way to go here, but potential there. All right. But let's just say it doesn't trigger. That's going to leave me in cash, another day here for the challenge. And let's face it, when we look at most charts, right, Bank of America is not going to give us a trigger anytime soon. Right? The 3-7, it's strongly negative, and for it to go positive, it would do what? It wouldn't give us a signal after this intensity of selling on the next 3-7 crossover to the upside. And that's the case with most stocks that are out there. And so how to manage it, how to kind of deal with this? Well, building the challenge algorithm and the application to the 100K challenge, one of the things that we looked at is, okay, how do we handle periods where there's no longer differentiation in the market? We basically have the market doing, everything kind of doing what the market does, because when that happens, we're not going to get many signals come in. And so do we sit on our hands for 2 to 3 weeks? Do we, try to chase into some things? Option prices are incredibly expensive, and for good reason. How do we manage that? And when we started the automated challenge back in May of last year, you may remember that there was a segment put in there where it talked about trading the MarketVibe and holding 1,000 in cash from the original, cash to put in play when the MarketVibe changes, when it goes from bearish to bullish or bullish to bearish, and to play it on the S&P. Now, I took that out. It did take long to take that out, just simply because we were getting signals. We weren't seeing these kind of panic periods. But I mentioned at the time that should we get these panic periods come in to where we're not going to get much of a signal, even on a bounce, right? We're just not going to get much there, that I would add that MarketVibe element in. And so that's what I'm going to do, or doing. If we do see a change from bearish to bullish in the MarketVibe, I will go out and play that with a SPY, maybe an EEM, maybe an FXI, maybe a EWZ or EWW that are on the watch list, and go and trade that without the upside crossovers, and just put some of our gains into play, just to get some traction. And the fact of the matter is that when we go through periods of panic, the upside rebounds can be very strong. So can do those, for relatively cheap, relatively little risk, in terms of ruining a challenge or totally altering a challenge. I think get some nice reward potential. Now, we're not getting any real shift in the market vibe today. In fact, the market vibe yesterday hit -7. I suspect we could see a market vibe at -9 or 10 today, just given what the metrics, the internals are doing out there right now. So that's kind of how I'm going to go forward. I'm not going to just go chase into stocks because, well, I need to be in something. No, I'll continue the process, continue, to be patient with the process, and, add that market vibe element there. So, if and when we do see the market vibe, create an upside trigger, we have an opportunity to get in and ride some of the upside there with it. Okay. All right. So that's the challenge. Again, I'm not making any changes. Going to sit in cash here for it and go. All right. Now, the nature of panic. We have a pullback in the market right now that is simply different than the market has experienced for a while. If we come in and just, broaden this chart out, the market has not dealt with this in well over a year. If we come in and put the last 2 years, has the market dealt with this type of a panic sell in the last couple years? It really hasn't. Let's see. Update. There we go. There was some in December of 2018 as we went into year end, as there was concern over a U.S.-China trade deal. But that was the last time where we saw a real panic come into the market. And right now we have real panic. It is real panic, and it is an element of increased uncertainty. And when uncertainty increases in the markets sell. When certainty increases, the markets get bought up. And we are in a period with all the coronavirus stuff, and I know there are tons of opinions out there, but when we look at how it's affecting the markets, it is creating an environment in the market where it makes things more unknown going forward in terms of earnings, revenues, economic data. The key drivers of the market are becoming less and less known, more and more unknown, and that's where we see panic come into play. This isn't your garden variety pullback that we saw on some trade deal news last year. This is one that puts fund managers in a very different position. Fund managers are down on the year. You think about market perceptions. This market's Teflon. This market just keeps going up. Man, this market is so bullish, blah, blah, blah. The market's down on the year. Fund managers are sitting there with losses on the year for the most part. And you think about trading psychology or investing psychology. Think about yourself. Think about getting into a trade. If you're in a trade and you're strongly green on the trade, are you going to be a little more patient with it? If you're up big, you're going to be a little more patient with some of the dips and the rips that come into play? Yeah, you are. If the trade goes red, and you're sitting there with a big, fat red position, you going to be as patient with it? No, not normally. Normally, most people will respond by trying to find different. Why is it doing this? Why is it doing that? What does this mean? Where is it going to find this? They're asking a lot of questions. Same thing goes in the market. When we go through periods where the market turns red on the year after a pretty good start, it brings in a lot of questions. It creates more panic. and you add that market going red element to what we see with with the coronavirus, and now seeing companies coming out warning about revenues and earnings for quarters to come. Microsoft today talked about their supply chain getting dinged and disruptions there. It just is creating more and more panic. How does the market respond to panic? Panic is one of those things in the market that gives opportunity. And every time I say that, gives opportunity, I'm always asked, well, what's the opportunity right here, right now? And I'm not saying there is, right? For me, there's not great opportunity right here, right now. Yesterday, I talked about some of the stocks that I expect to be bought up after a pullback, but I'm not buying them yet. Chipotle, Visa, Netflix. I'm not a buyer of these yet. I need to kind of see that panic come in. I need to see the market element subside a little bit, to go out and buy them. So it's one where I don't think the opportunity is right now. Could you go buy puts? Yeah, you can go buy puts, and hey, the stock could rally $60 tomorrow. For me, it's just when we get in these periods, I'm not going to sit there and try to predict what the next $60 is. I find that pretty arbitrary, and it's more gambling than trading or investing. But when we have these periods of panic, the opportunities are start to shape up, for investors in the long haul. Let's go take a look at a couple periods of time where we saw the market just kind of switch from a complacent mood, right? That's just semi-complacent mood to a really heavy panic mode, where we saw moves in stocks that were just very outsized relative to what the market was used to. And we're going to look at 4 years time period, and we'll show kind of how the market responded, and these represent what the norms are. Let's start with the abnormal. Let's start with this. Back here in 2014, this was the Ebola virus. Took some time to, get that fear panic, but that fear panic finally came in, was pretty strong. We got a big volume bottom and a V-shaped recovery. That's unusual. That's not the norm. That is not the what we will see in other periods of panic. But that is a possibility. And when we go back and we look at periods of panic, we see this about 20 to 25% of the time. About 1 in 4, 1 in 5 of these kind of bigger panic sell-offs that are driven by a hefty catalyst, where it's multiple days. It's not just 2 days. Right back here, we have 3 days creating a sell-off. That's all it is. It's selling in 3 days. That's not a panic, driven market. Here we have, selling that's happening over the course of 2-3 weeks, that panic element coming in. So this is the unusual. This is the abnormal. A lot of times these V-shapes are we see massive volume at the bottom, and, it's one where the upside is almost faster and more abrupt and more sudden than the downside, and it's normally on bad news. It's not like the news all of a sudden changes and everybody's now bullish. It's still one where there's a lot of worry throughout most of the upside, but the market just continues to see buyers. We go then into 2015, and we get a complacent market, a market that really doesn't move. And this was a very annoying time for the challenge and looking for, stocks to move in a market that just had nothing to do with really wanting to move. The range on the market today is greater than what the range on the market was for a 6-month period here in 2015. Just to put it in perspective, we've had a bigger percentage range today than what we saw in this 6-month period. And that's incredible, right? So there's a complacency element that comes in. and then we get whoosh. Now, this sell-off here wasn't a sell-off where the panic was pointed to one or two things. This wasn't a sell-off where you could look and say, well, it's coronavirus related, or it's Ebola related, or it's flash crash related, or Euro crisis related. You couldn't do it. This sell-off left investors scratching their heads, going, what's going on? What's happening? What's taking place here? And ultimately we find out this is China dumping a lot of assets. How does this play out? Well, this plays out pretty normally. We get the panic, happens over a 5-6 day period. Then we get a relief bounce, some chop. We don't get the bulls committing. We don't get the bears selling. And then we get another kind of flush down. That's secondary sell, which is very common in these panic elements. And then what do we get? We get a rebound. This is a normal market correction. This is not bear market. This is normal market corrections. And the way that we tend to see volumes play out, the way we tend to see price action play out, and you'll notice it's over a 3 to 4 week period, which is a very normal time period. We can go back and look at other pullbacks. So here we have 2010 and 2011. 2010, we get this thing called a flash crash, right, that comes in, and then we get the sharp rebound. Then we get the pull on back. We get some Euro crisis stuff that comes in, push to a new low. This one takes a little longer. Why? Because there's a secondary element that comes in. The flash crash element shakes itself out. Right? The flash crash element is all kind of shaken out here with the retest of the lows and the normal time period, and then we get a double dose with Euro crisis worries. And then we get that panic sell to a new low, nice little rebound, another little sell, higher low before things are off and rolling. Then we get into July of the next year, and we get the panic sell that comes in outsized. This is over Greek debt, Portugal, Italy, Spain, Greece, what their debt looks like in Europe, and the panic that ensued with that. Harsh, big sell. How does the market respond after? Look at that range, and look at those moves. Those are massive. Those are big moves for a long time. That's more normalized in terms of how these panic situations come. So if you're looking at this panic situation going, well, what do I do today? And, am I going to miss the bottom today? You could. If you don't buy today, you could miss the bottom. You could be out. But that would be highly unusual. And for me, market anomalies are not what I try to be a part of. I'm not interested in trying to predict or be part of an anomaly. I understand anomalies happen. I understand the risk factors are there. That's just part of the market. But I want to be prepared and be ready to take advantage when there aren't the anomalies, when things play out normally. And so what do I expect with this panic that we see in the market right now? Well, I expect that there's going to be some hefty chop. There's going to be, the big drops. There are going to be the big chops. I am sure that today you will be able to go to many market sites and hear this argument. Buy the S&P because it's at its 200-day moving average. Right? Look, here it is. It's at its 200-day moving average. Well, we go back into these time periods. Let's put a moving average on. Let's just try to apply technicals. Let's just go with a 50-day and let's go with a 200-day moving average. Very basic technicals, and very easy for most investors to see. Did the 200-day moving average much matter right here? No. We saw stocks fall to it and then rebound, for a day on it. Then it flushed lower, and it flushed on back. Was the 200-day moving average a real big deal? No. What about the 200-day moving average right here? Was it much support? The 200-day moving average had been support for a long time. Is it support here? No, it's not. Is the 50-day moving average resistance? No, it's not. It's the 200-day moving average resistance? No, it is not. When we go into these panic periods, these these types of technical arguments get thrown out the window. Why? Well, because they don't matter. That's not why the market's selling. The market isn't looking and going, "Oh man, we just broke some moving averages." So, now that means disaster. Right? I mean, you look at how relevant the moving averages are right back here, they aren't at all. Right here, they're not at all. Moving averages are relevant in bull markets with normal kind of corrections, with individual stocks more than with the overall market. When the market's in panic mode, the nature is that technicals don't matter. Overbought doesn't matter. Oversold doesn't matter. The market is going to react because you have fund managers, you have traders, you have investors now that are sitting there and going, "Oh man, I just took a huge loss. I can't take anymore. I can't take anymore." They have to start switching into that sell stance. They're not selling because of a 200-day moving average or a 100-day moving average or things like that. And ultimately, the market does find, some type of support, and there happens to be a technical level that it finds it at. But that's more happenstance. That's more hindsight. Oh, there it was. In real time, you can look at dozens of levels that could potentially act as that support level or the end of the panic levels. And in hindsight, yeah, you can see it. In real time, there's always dozens of them that you can make very good arguments for. And when it finally happens, all those dozens get swept under the rug by technical traders. They choose to ignore it, and they focus on, what worked in this instance, and they go with that and see, here's the technical with how it worked in this instance, and with no thought to the fact that the next time it's not going to work that way. The time before it didn't work that way. And so to apply, technicals here is just not all that great. 200-day moving average coming into play. Could we find some support off this level? Sure could. No, sure could. Bank of America investors who bought Bank of America yesterday off the 200-day moving average, well, what do you think they're feeling today? they're not feeling too hot, are they? You look at J.P. Morgan. I mean, they haven't had a chance to buy off the 200-day moving average yet. So, the nature of these panics is one where we're going to have a lot of chop, where a lot of the technicals go out the window, and where you look for key levels to come in. As I've watched the market the last few days, that's what I've been looking for. Key levels. Are there some key levels based on volumes, based on price action, that suggest that this is a major level going forward? And so far, the answer is no. There just simply isn't. We could ultimately see one come in today where, this is an important level. We bounce off this level. We come back, retest, and all of that, sure. But so far, we have just not seen anything that you can look at and say, hey, this is a very key level. Now, I've been watching S&P futures this morning, and even since I've been on video, we have seen S&P futures fall 20 points in a matter of a couple minutes, and they have rallied now, almost 40 points, just shy of 40 points since I've been on video. That's the magnitude of moves that we're talking about here. They're massive. We haven't seen any big bottoming volume. Yeah, we're seeing 20K volumes. We're seeing consistent 10K volume. There's a massive volume here. But we're not seeing anything that we go, oh, okay. Well, because of the volume here, this level's significant, going on forward. Right now, market just continues to be in a free fall type of mode. It's one where it rallied 90 points yesterday off the low in S&P futures and ended up giving all that up in a matter of hours. We're going to see more of that. The uncertainty element is going to create more and more of that. And yes, we could get a V-shaped rebound. And if you don't buy here, you may be missing out. But that's not the norm. The norm on these types of moves is that, yeah, we'll get a rebound. We'll get a sell-off. Then we'll get a rebound. We'll get another sell-off. And it'll play out over the course of 2 to 3 weeks. And that's what I expect. That's what I think would be, much more normal. We do have to see that, something with the coronavirus gets, calmed down. And so far, that's not happening. So far, when you look at the data, the numbers, when it comes to coronavirus, it's only getting worse. And you're starting to hear some things about, travel, people staying home, those types of things that, let's face it, weren't in the markets a week and a half ago. I mentioned earlier in the video that this type of market provides opportunity. And, for me, I look at it and say this is providing an investment opportunity that we haven't seen in a long time. Which means I'm watching my fundamentals. I'm watching my fundamental charts. I'm looking for stuff that comes into fundamentally cheap levels. For example, AT&T. Hard pullback, pretty strong pullback. All right. Is this coming into a fundamentally interesting level to where I can go out and be a part of it based on the fundamentals? Well, price to book value is at 1.4. This is one of the lowest price to book values that it's seen in a long time. What about price to sales? Price to sales 1.4. Okay, we're no longer on the high side, but we're definitely not at the low side. What about dividend yield? This is the one that has me most interested with a lot of stocks. The sell-offs are going to create some better dividends. This AT&T now getting up to 5.6. It's still not in that 6.5 to 7 area that it was, last year as we talked about it at its lows and being a great buy opportunity. So, all right, it's improving, but it's not, a fundamental that I go, wow, this is now super cheap and something where I can buy it fundamentally. Here's Verizon. Its dividend yield has been stuck down here in the low 4s. It's starting to move on up. It's going to take a lot more selling to get that into a really attractive period. And as I go through the fundamentals of a lot of stocks that are out there, the fundamentals are improving in terms of the valuations. Naturally, stocks go down, valuations improve. But they are nowhere near cheap levels. They're nowhere near even the levels that we have seen over the last 5 years that come into play after sell-offs. And so for me, it's just still too early. It's still too early to want to jump in and be super aggressive and, to really kind of chew on something like a Chipotle Mexican Grill and figure out, well, how do I want to get in? How do I want to be involved here yet? Still a little early. And will we ultimately see the stabilization? Yeah, we will. Do I mind holding Chipotle Mexican Grill at $700 or $800? I don't. But, at the same time, I'd like to get them as cheap as possible and look to step in when, some of the normal plays out. And that is when we see a little rebound, then another sell-off, because what's going to happen to option values, they're going to get cheaper when that happens. The VIX is going to come down. Implied volatilities are going to drop. And we will see that, happen over time. But when we're in the middle of this panic, the nature of panic is highly, highly overpriced options, and for good reason. And, which just kind of leaves me to say, well, all right, I'm willing to step in and maybe be a buyer. And can I grab some Chipotle here? And can I sell some put options for a good price? I mean, these may be prices I can't resist. I can sell a June 770 on Chipotle for $50. That leaves my entry point at what, 720? Am I happy with a 720 entry point on Chipotle? Yeah, I really am. Right? So, some of those are starting to get pretty compelling. and I may step into a few here today, depending on how things shake out. But yeah, that's kind of how I'd look to step in. If you are looking to step in aggressively or dip your toe in, but step in with something like that, but knowing that hey, it could blow through it. I sold some Boeing puts the other day to where I basically got a 295 entry point on them. Today, Boeing has blown through it. I'm sitting at a loss on the position now, but it's a long term. I know the shares are going to get put to me. I'm happy to hold them to weather everything out. I can hold it for a few years and be okay. So I'm not too concerned about it. But if you're not in that position to where you're concerned about what it does tomorrow, it's a very kind of rough environment. It's one where stick to your short-term technicals and trade the short terms as you see, and let the long-term elements kind of just shake themselves out over time. Thanks for hopping on. Have yourselves a fantastic day, and we'll talk to you this afternoon. Take care.